I'd like to thank you for joining me on this important recording in your advanced financial reporting class. My name's Gandalo Joseph, and I'll be running you through this lecture series. I hope you've got a paper and a pen in your hand. Today, I want us to focus on the framework for financial reporting, and at this level of your studies, it is very important to appreciate that your submissions must be strong, and they're strengthened, of course, by a framework for financial reporting. As a profession, we subscribe to a framework for financial reporting. So in our focus, we shall ensure that we appreciate the key principles underpinning the conceptual framework of financial reporting. And I'd like to start with that question: why have a framework? The IFRS framework describes the basic concepts that underlie the preparation and presentation of financial statements for external users. And that is, our framework is specifically meant to address the needs of users of general purpose financial statements, and it will be very important to know from the onset that we are dealing with principles here. Okay, so why have a framework? Again, a conceptual framework can be seen as a statement of generally accepted accounting principles or indeed practice. The framework itself is not a standard, but it's a frame of reference for the evaluation of existing standards as well as the development of new ones. I wanted us to also appreciate the concept of fair presentation in our discussion. Fair presentation is a term used in IS 1, presentation of financial statements, which is equivalent to the concept of true and fair view. For the record, fair presentation is made when the financial statements comply with international financial reporting standards, as well as international accounting standards, as well as the interpretation of IFRS. Let us now look at the purpose of the framework, and these are not going to be exhaustive points. My work here is to inspire rather than to regurgitate detail. Well, first of all, the framework is there to form the basis for formulating international financial reporting standards, and that is, if we consider that there is need in an area of accounting for a new standard, we must formulate a standard in line with the spirit of the framework. We need to ensure that international financial reporting standards also proactively resolve accounting problems, and so our framework will help us to come up with what we call proactive standards. This point will be recited or re-emphasized very soon. The framework provides guidance on issues not specifically addressed by the international financial reporting standards. That is, there is a unique situation which has not been addressed by an IFRS. It will be very important for the preparers of financial statements to trace their way back to the framework, see the spirit of the framework, to see rather if the spirit of the framework can help them to arrive at the right conclusion. What are the advantages of having a framework for you accountants and those who are interested in this career? Well, number one, Financial statements are going to be more consistent with each other if we use a particular framework. All right? And of course, consistency in this case means that we should be able to make meaningful comparisons of financial statements for different entities. Framework also helps us to avoid firefighting in the way that we develop standards and also resolve problem areas in accounting. Framework will also cover us from potential criticism uh, or indeed political or external pressure, because we'll be seen to be more organized if we subscribe to a particular framework. Are there some disadvantages to having a framework? Yes, we have. Now, it is not conceivable to think that one framework can help us to meet the needs of different users. And that point is built upon on the second point. The need for a variety of standards means that we may need different frameworks. Preparing and implementing standards has not proved to be any easy with the framework. So it's an ongoing process of development and innovation as well as improvement. We need to appreciate some of these points. Okay, let us now look at the contents of the framework. The contents of the framework. The contents of the framework. So we have got the purpose of financial statements. I'll be addressing that in a bit. The elements of the financial statements. The recognition of the elements in the financial statements. Measurement of the elements of the financial statements. The underlying assumption, the concepts of capital maintenance, and we have also got the qualitative characteristics of accounting information. So I'm going to deal with one at a time. Let's start with the purpose of general purpose financial statements. The purpose of financial statements is to provide information, and that information in turn would improve decision-making processes on the part of key stakeholders. And I think the key stakeholders that are being identified in our definition here include investors, lenders, and other creditors. All right, so let us remember the word information in our learning. Let me go to the elements of the financial statements. I'll get back to the recognition. I wanted to see if I can just dwell on that. So we have 5 elements of the financial statements. I think by now you should be able to appreciate. The word asset simply means the resource controlled by an entity as a result of past events. Of course, we expect to derive exclusive economic benefits from our assets. These assets, of course, come in 2 forms, long-term and short-term. We also have got liabilities. These are present obligations, and they, of course, arise out of legal constructive, arrangements. But liability also has got 2, forms. We have got non-current liabilities and current liabilities, long-term and short-term liabilities. Income means the general increase in the economic benefits of an entity and does not include contributions made by equity participants. We have got expenses. This is general decrease in economic benefits of an entity but excludes all distributions made to equity participants. Then equity. Equity means owner's interest in the business. This is the so-called capital plus reserves that we have come to appreciate. I want to get back to recognition. And is it recognition? Yes. So an element is recognized when two things are present. When we are able to reliably measure the element, and when there's what we call probable flow of economic benefits. So if you're dealing with an asset, the company will have the economic benefits, but if you're dealing with a liability, the company will lose economic benefits. Now, the word probable is not consistently applied to the recognition of assets and liabilities for all international financial reporting standards and ISs. If you consider International Accounting Standard 16, for instance, you will find that the word probable is used for the recognition of property, plant, and equipment. But if you consider IS 37, you will see that for virtually certain assets, or you consider rather for contingent assets, if these are virtually certain, they will still need to be recognized. So we depart away from the word probable, but we go to the phrase virtually certain. IFRS 3 advocates for the recognition of material liabilities in the acquiree regardless of the level of probability, assets as well as liabilities, I should say here. Because when you buy an investee or a subsidiary, you buy everything that is within the subsidiary. So everything becomes, purchased and therefore can be allocated with values. All right. Exposure draft 2015 recognition criteria states that for us to recognize an asset or a liability or indeed an element, the element should meet the definition or which is stipulated in the framework. And then there must be flow of economic benefits. And also you have what we call reliable measurements. Now, for an item to be recognized, the reporting entity should consider the item's relevance. That is information relating to the item important to the users. We should consider faithful representation. And that is the information relating to the item or element, reliable. And then we need to consider the cost of providing information, which should be less than the benefits thereof. I think I've discussed that. Let me now go to measurement of the elements. And this is something that can be appreciated at a very detailed level, but elements can be measured using the following basis. We have got historical cost. Historical cost is a widely used measurement basis because it is said to be more objective and it is said to be less open to manipulation. So historical cost simply means transaction value. It is the amount at which we could have, bought an asset, or the amount at which we are expected to transfer a liability. Net realizable value, this is simply the selling price of an element less the cost to sell. Replacement cost is the cost of replacing an asset. Where we have got an absence of information, we can still find out how much would it cost to replace an asset, and that will be its value. And then we have got present value, which is the discounted cash flows. of an asset or indeed liability. The underlying assumption of the financial statements. So going concern is the only underlying assumption of the financial statements. And that is when the financial statements are prepared, normally we assume that the entity will be in operational existence for the foreseeable future. Now, extensive disclosures should be made if an entity's future is in doubt. If the going concern assumption is not applicable, the financial statements must be prepared on what we call a different basis. Capital maintenance. Well, I thought I'd discuss this with you as well, and I think that we almost now reaching the end of the discussion under the framework. Capital is maintained if profit is generated under the financial concept, and capital is maintained if the productive capacity of an entity increases under the physical concept. All right, now allow me to go to the qualitative characteristics of financial information. I will start with the qualitative characteristic known as relevance. Information is relevant if it can make a difference in the economic decisions of users. And relevance speaks to materiality. Information should be important, at least from the user's perspective. Information should also possess predictive or confirmatory values, or indeed both. Faithful representation, the old word here we used to use is reliability. Information must represent what it purports to represent, and that is, it should be complete. All disclosures and explanations should be given, of course, without breaching the rule of confidentiality. The information must be error-free. The information must not be biased. It should be neutral. Understandability speaks to comprehension of the information provided, and that is, can the users understand the information that they have been provided with. All right, so for understandability to take effect, information must be presented in such a way that it is understandable to the users, and it is expected that the users are diligent enough to read information presented to them and to make all necessary efforts to get to understand what is being put before them. Comparability means information should be subject or is capable of being subjected to analytical procedures. And of course, the ingredients there are consistency and disclosure. All right. Timeliness means information should be provided on time if it is to be relevant. Timeliness also speaks to the need to take enough time to present complex information to minimize the presence of errors. Verifiability means information should be auditable. That is, it should be traced to let's say source document or an underlying record. All right, so we look away from the framework by simply stating that the benefits of reporting information should justify costs. The benefits of gathering information and presenting that information must justify costs. All right, so now I wanted to touch on IS1 just briefly. This is carry forward knowledge. The standard IS1 provides us with guidance on how to present general purpose financial statements. I want you to take some time to read through the standard information. There's a lot of information on the internet regarding all these standards. You can Google IS Plus and you'll be able to discover that you've got a lot of information there. All right, let us try to jump in straight to interim financial statements. Now, if interim financial statements can be defined as that financial report containing either a complete set of financial statements or a set of condensed financial statements for an interim period, meaning a period that is less than a financial year, that is less than 12 months. I think I can make mention of that. What are some of the components of interim financial statements? We have got the position statement, we have got the performance statement, we have got the statement of cash flows, we have got the sourcing, the statement of changes in equity, and the selected explanatory notes. Now, interim reports are voluntary as far as the standard is concerned, IS 34. However, IS 34 applies where an interim report is described as complying with IFRS, and publicly traded entities are encouraged to provide at least half-yearly interim reports. Regulators in a particular regime may require interim reports to be published by certain companies, e.g. those companies that are listed on the stock markets. Okay, great. So I want you to take time to write this, what is in the table. And it's very important for us to appreciate the way you present information in your interim financial statements. Okay. These points that I have before me, I think I've tried to mention this. In your interim financial statements, you need to have limited notes to the financial statements, and then disclosure of key events. This could include estimates, unusual transactions, and changes in capital. You need to communicate. Now, there is need to ensure that you apply the same accounting policies as those for a full accounting period in your interim financial statements. You need to ensure that revenue is not anticipated or deferred. If doing so would not be appropriate. We have got the issue of a accelerated revenue recognition, which is not an ethical way of dealing with things. Costs are not supposed to be anticipated or deferred. If doing so would not be appropriate. And then estimates arrived at should be reliable. I would like to thank you for listening in to this record, and I know that you are taking some notes. I just want to stop here for now. I'll send you a question, but if you have got any question for me, you can always reach me on this line. Let me just type it for you. I think I didn't type my line, so you can use that line there. You use that line there. Okay, it's a Zambian line, and I hope that you can give me some feedback on this video. Thank you very much for listening in.